All right, so let's dive straight into chapter 2. So for the purpose of this chapter, I'm going to explain to you guys the theory and the formulas behind each question as we do each question. Just because in that way, I can read you guys the question, explain to you guys the theory behind it, and then we can apply it right away. That's the best way to learn accounting. Also, I've taken some things from chapter 0, which is, remember, the general overview that I taught you guys at first. So I'll be referring back to this a lot too while I teach you guys this chapter. Let's dive right into it. The first question is, how is the business's wealth calculated? Remember, we talked about shareholders' equity as being the company's net worth, correct? That's equivalent to the business's wealth. The business's wealth is calculated by taking assets, subtracting your liabilities, and this in turn gives us our shareholders' equity. So that being said, business's wealth and shareholders' equity mean the same thing. It's the same thing as your net worth. The next question is, what is the effect of buying office supplies on the wealth of a business? Okay, so the first question you want to ask yourself is, out of the 5 main accounts in accounting, which account does office supplies falls under? It's going to be an asset because it provides us with a future benefit, correct? So it's nothing to do with the net worth of a business because it's an asset. And remember, we talked about the 4 financial statements. Shareholders' equity is impacted by retained earnings. So that means that the statement of retained earnings, anything that happens within that statement is going to impact shareholders' equity. Thus, the beginning retained earnings balance plus any profits or subtract any losses. That means if expenses exceed revenues. Subtract any dividends gives us ending retained earnings balance. And profit is a product of revenues and expenses. So since office supplies is an asset, not a revenue or expense, it's not going to impact the business's wealth. Simple as that. If we purchase it using cash, once again, cash is a future benefit. Once again, it doesn't impact the business's wealth. Simple as that. Or if we purchase the office supplies using a credit card is a liability, a future obligation. Let's dive straight into PQ2-2. So the owner of a business contributes $12,000 to a business. So contributes $12,000 to a business. During the year, the business has expenses of $32,450, and they paid a dividends of $2,000, and we have earned revenue of $41,200. What is the equity of the what is the equity at the end of the year? So we're going to first imply the formula from the income statement to calculate profit. So profit equals to revenues minus expenses, or in other words, profit equals to 41,200 minus 32,450, and this is going to give us 8750. Next, we're going to apply the statement of retained earnings formula. So remember, that is going to be beginning retained earnings balance plus profit minus dividends gives us any retained earnings balance. Retained earnings equals to beginning balance, which in this case is not given to us, so we're just going to assume it's 0. So we don't have to be given every part of the formula. So this is why you have to learn the material rather than memorizing the actual material, right? It's very important because if you know the material, then we can apply logically to different situations. Plus profit minus dividends. So that means retained earnings equals to 0 plus 8750 minus 2000. So we're going to take 0 plus the profit minus dividends, and that gives us the ending retained earnings balance. So over here, we discussed that shareholders' equity is comprised of retained earnings. Now we're also going to expand our knowledge, and now we're also talking about owner's capital. The owner's capital plus retained earnings gives us shareholders' equity. Those are the 2 main accounts under shareholders' equity. So shareholders' equity equals to owner's capital plus retained earnings. So owner's capital is when the owner invests money into the business. Retained earnings is profit that we made that we haven't paid out in dividends. So that means shareholders equity is going to be equal to 12,000 plus 6,750. So 12,000 plus 6,750 gives us our ending balance in equity at the end of the year.